Well, there's no doubt about what stock we're going over this week, and that is Nvidia, because it has been shooting to the moon, and we've been talking about it all year. So let's get right to it, folks, and let's see what it does. Well, it's a leading developer of 3D graphics and multimedia processing technology using PCs, gaming console, and other devices. And the customers are all the biggies: Microsoft, HP, Dell, Fujitsu, Siemens, NEC, Sony, Toshiba, Apple, and other OEMs, which means original equipment manufacturers, and also system integrators. Production is outsourced to Taiwan Semiconductor and our old friend IBM. And our R&D, research and development, was over 20% of 2022 sales, and international sales accounted for 81% of revenues. And this is why it got hurt when the Russian-Ukraine war went on, because Nvidia had people working over there and had to move them around, on and on. Well, it's got about almost 18,975 employees. But let's see more about this stock. Now, Nvidia is one of the most mentioned companies in the U.S. across all news items in the last 12 hours, according to Factiva. And the graphic chips company unveiled a set of new products and clients to further drive demand for, get this, AI. Yep, artificial intelligence. You hear that word? The stock's going to go up. And it prompted a raft of Wall Street analysts to raise, and there's about 40 of them, folks, to raise their price targets on the company's shares. And right now, as we're recording this, Nvidia just rose 25.5% to $383 a share. And I'm recording this at the close on Thursday. And let's look at Jim Cramer's group when he has an investing club, and this is what he says about Nvidia. Following Nvidia's incredible quarter and strong guidance raise, we think shares of AI, there it is again, AI chip powerhouse can increase another 14% from its record highs in the next 6 to 9 months. All right, folks, listen to me on this, and listen very, very carefully. I don't like when people say the target price is going to be this or it's going to be that. You take a company like Nvidia, which has been growing and growing and growing, so people think when they see a price target of 14% from its record highs over the 6 to 9 months, they think about selling it when it rises another 14%. Why in the world would you get rid of a perfectly good stock from your portfolio? Remember what Warren Buffett says: buy a good stock and keep it until it's not a good stock anymore. So that's what you have to watch out for. That's why I don't like the target price theory and methodology. It's just not right for me, because we've had this stock in our portfolio since it was around $50 a share, and now it's almost $400 a share. All right, let's go on, though, and let's see what he says. Now, that's generally our time horizon for a club price target, which we're boasting on Nvidia to $450 a share from $300. Well, right now it's $383, so it's almost up to his $450. And he says we're keeping our number 2 rating on the stock, which indicates we would want to wait for a pullback before buying more. Well, folks, if you've been following us, there's no more you can fit in your portfolio, because we've been talking about Nvidia all year. And Cramer goes on to say our new $450 per share price target on Nvidia is about 45 times full calendar 2024 earnings estimates. I want to show you about this. He's talking about a PE ratio of maybe 45, and I think it might be a little bit over that when this share settles down, or when we look at the $380 some per share. But anyway, I want to talk about this 45 times earnings, and we'll do that in just a second. Well, the second's almost here, so let's look at a chart. For those of you who don't like to look at numbers, let's look at a graph. And the blue lines are the average database stock in our stock database, which is about 1,900 stocks. So the clean surplus ROE of the average stock is about 13.5%. So remember, we figure out the return on equity a different way than traditional accounting return on equity, a totally different way. And you can see that in our book. If you subscribe to our 2-week free subscription, you will get a copy of our book, a PDF copy of our book. So anything above 13.5%, any stock with a clean surplus. Now remember, we're talking about clean surplus return on equity. Above 13.5% is usually a better stock than the average stock. Remember that 96% of professional money managers who manage the publicly traded mutual funds, 96% cannot outperform the S&P 500 over any 10-year period. And that was a report put out by Morningstar 2002, and it exists today, folks. So Nvidia, clean surplus ROE, 33%. We're looking at almost 3 times that of the average stock. Now, net income growth, and what is net income? Net income means the clean surplus earnings. So you take traditional accounting earnings and you subtract the non-recurring items, and we go over that in our book quite a bit, and you take away future liabilities. So the average stock has a net income of about 13%. Nvidia, 47.5% net income growth. So these are growth numbers, and they're 5-year averages. Look up here. 5-year averages of net income growth, which is the clean surplus earnings. Net income is clean surplus earnings. I repeat myself. So 47.5% for Nvidia. Now you can see why it has been shooting up, and that's all you hear about. Now revenue, about 7.1%, 5-year average, and Nvidia has a 28, so 4 times the revenue of the average stock out there in our database. So folks, the question is Nvidia better than an average stock? And the answer is, wow, no doubt about it. Now, for those of you who like to look at numbers, we can see a few more things. And I want to look over here at retention rate. Retention rate is the amount of money a company makes that it puts back into itself in order to grow. Well, evidently, Nvidia thinks there is a lot more growth for it and its AI inventions or research that it is coming out with. And so it's putting just about all the money it's making back into itself in order to grow. And when we look at years to pay debt, this is Buffett's rule. He says if a company takes all the money it's making and uses it to pay off debt, how many years would it take to pay off the debt? His rule of thumb is 5 years. Our rule of thumb is 3 years. This company can pay off its debt in 6 or 7 months. And that's a good feeling, because even if interest rates go up, this stock will not be hurt relative to its debt, because it has all the money in the world in order to make the debt payments or pay off the debt entirely. And we will look at this market cap of $431 billion. And folks, that number is going to change as soon as the dust settles down over the next couple of days. So everything we are looking at with this company is good. Now let's look at what it has done price-wise over the past 1 year. Black line is the S&P 500, and we can see Nvidia was holding its own against the S&P 500 until about 4 months ago. And don't forget, we've had a buy rating on this stock for the past 5 years. So recently, this stock has started to take off, and then all of a sudden this morning, and I'm recording this on Thursday, this morning this stock shot up, and it shot up 25%. This is a 25% move in here. Folks, you're not going to see that very often in one day. So take a good look at this 25% move in this stock. And when we look at the past 5 years, this stock, and we were talking about this stock approaching its previous high. How many stocks do you know of that is above or approaching its all-time highs in this particular year? We just came off 2022, where the S&P was down 19.6%. The NASDAQ was down 34%. So where do you find a stock that is approaching its old highs so quickly? And it has not only approached its own old highs, because that's what we were talking about last time we talked about this stock. The stock was sitting right around in here, and now all of a sudden it has blown through the old highs of this stock. It is up, folks, get this, it is up over 500%, while the S&P down here is up 50%. over the past 5 years. This stock has outperformed the S&P 500 by 10 times. Now, that's the kind of stock you want in your portfolio. There's no doubt about it, folks. We like Nvidia. We're going to keep it. We've had it for a long time in our growth portfolio because this is one of our favorite stocks. And by the way, Nvidia is in our ETF portfolio. Now, for those of you not familiar with our ETF portfolios, we take an ETF and we take the best stocks using the clean surplus return on equity. So we take the top 5, 6, 7 stocks in any ETF, and we buy those stocks rather than the ETF itself. And the research and the real life portfolios have shown that the stocks with the highest clean surplus ROEs, return on equity, outperform stocks with lower return on equity. It's just common sense, folks. And this company now, as of today, the top 5 stocks in our semiconductor ETF, or our portfolio of the semiconductor ETF, which includes 5 stocks, is up 55%. Folks, you want to see the ETF, and that is one of our subscriptions. You want to see this ETF video because, folks, it is phenomenal. We have a portfolio that's up 55% year to date since the beginning of 2023. Year to date, up 55%, and it's a real life portfolio, folks. So, yeah. We like Nvidia. It's been very, very good to us. And yes, we expect to keep it in our portfolio for a pretty long time to come, folks, if not forever.